The Department of Government Efficiency, DOGE, has terminated a $170 million contract with Pantheon, which was responsible for transferring critical Navy personnel data to a secure cloud platform. This move leaves a key Navy server, which stores essential pay and promotion data, without a disaster recovery plan, raising concerns about data vulnerability. The server, one of the last remaining Navy data centers in Tennessee, is crucial for the Navy's HR operations, including the promotion of sailors. The cancellation of the contract, perceived as a misstep by insiders, could delay the Navy's ability to effectively manage personnel promotions for up to 16 months. The decision comes amidst broader financial and strategic shifts within the U.S. military. President Trump recently promised significant pay raises for military personnel, while a GOP reconciliation bill has earmarked a $150 billion package for the Pentagon. This occurs in a context where U.S. military spending reached $997 billion in 2024, accounting for a significant portion of NATO and global defense expenditures. While DOGE aims to cut inefficiencies, the abrupt contract termination has sparked criticism, highlighting the challenges in balancing cost-saving measures with operational effectiveness in military infrastructure.
The recent passage of the One Big Beautiful Bill Act by House Republicans has sparked significant debate due to its perceived benefits skewed towards wealthy Americans. The bill, which includes a range of tax cuts for businesses, estate taxes, and income tax rates, is expected to funnel the majority of its financial advantages to high-income households. Analyses from the Congressional Budget Office, CBO, and Yale Budget Lab suggest that by 2027, income for the top 10% of earners could rise by 4%, whereas the bottom 10% may see a 2% decrease. This disparity is largely attributed to the bill's partial offsetting of tax cuts with reductions in social safety net programs such as Medicaid and SNAP. The bill's implications extend beyond simple tax cuts. It proposes increasing the SALT deduction cap and maintaining a reduced top tax rate of 37%, initially set by the 2017 Tax Cuts and Jobs Act. These measures are expected to disproportionately benefit high earners, as evidenced by the Tax Policy Center's findings that 60% of the bill's tax cuts would go to the top 20% of households. Despite some provisions aimed at aiding lower earners, such as an increased standard deduction and enhanced child tax credit, the overall impact on low-income households is negative due to significant cuts in essential federal programs. As the bill moves to the Senate, its future remains uncertain, with potential amendments likely to address concerns regarding its regressive nature and impact on the federal deficit.
Pakistan is set to offer investment concessions to U.S. companies in its mining sector, as part of ongoing tariff negotiations with Washington. This strategic move comes as Islamabad seeks to mitigate a potential 29% tariff on its exports to the U.S., a repercussion of a $3 billion trade surplus with the U.S., following tariff announcements by the Trump administration. The Federal Minister for Commerce, Jam Kamal, revealed that Pakistan aims to attract U.S. investment, particularly in the Baluchistan mining projects, by offering joint venture opportunities and lease grants. This initiative aligns with efforts to boost imports from the U.S., especially in commodities like cotton and edible oils, which are currently scarce in Pakistan. The Reko Diq copper and gold mining project in Baluchistan is a focal point, seeking up to $2 billion in financing, including significant contributions from the U.S. Export-Import Bank. This project alone promises substantial economic benefits, with potential cash flows of $70 billion and $90 billion in free and operating cash flow, respectively, over its lifespan. These developments are part of a broader strategy to enhance U.S.-Pakistan trade relations, with President Trump expressing interest in forging big deals with both Pakistan and India. As Pakistan prepares to lower tariffs in its upcoming federal budget, these negotiations could reshape its economic landscape, positioning it as a more prominent trade partner with the U.S.
Phoenix International Limited, the owner of OnlyFans, is reportedly in discussions to sell the adult content platform to a consortium of investors led by the Los Angeles-based investment firm Forest Road Company at an estimated valuation of $8 billion. OnlyFans, which gained massive popularity during the COVID-19 pandemic, allows content creators to monetize their material by charging subscribers, with the platform taking a 20% cut of earnings. The company reported $6.6 billion in revenue for the year ending November 2023, marking a significant increase from $375 million in 2020. This rapid growth has piqued the interest of various investors, although the nature of the content on OnlyFans presents challenges for potential buyers. Given the platform's history of hosting illegal content, the potential deal is significant as it reflects the growing investor interest in digital content platforms despite the inherent risks associated with adult content. Forest Road Company, which has previously been involved in a special purpose acquisition company, SPAC, aimed at taking OnlyFans public, leads the talks, although other suitors are reportedly interested. The discussions, ongoing since at least March, could result in a deal within weeks, though there is no certainty of completion. The company's sole shareholder, Leonid Radvinsky, has reportedly earned over $1 billion in dividends from OnlyFans over the past 3 years. The platform's controversial content has made it difficult to attract traditional investors, but its substantial revenue growth continues to draw attention from alternative investment groups.
TJX Companies, NYSE, TJX, recently reported fiscal Q1 2026 earnings that exceeded market expectations, yet the stock experienced a decline of over 2% prior to the earnings call. Despite the robust earnings, the market's reaction seems influenced by concerns over the company's growth prospects and valuation. Analysts have noted that the stock appears richly priced, which might have contributed to the negative sentiment, despite the positive earnings report. The company's management remains optimistic about navigating upcoming tariff challenges, which could impact future performance. The downgrade from bullish sentiment by DM Martin's research suggests a shift in market perception regarding TJX's growth trajectory. This change in outlook could have broader implications for investor confidence, particularly in a market environment sensitive to valuation and growth potential. As a key player in the retail sector, TJX's performance and strategic responses to external economic pressures will be closely monitored by investors and analysts alike, impacting stock valuation and investment strategies in the sector.
Dubai is emerging as a prime destination for American investors seeking a stable and advantageous environment for wealth preservation and residency. Amid increasing geopolitical uncertainties and regulatory changes worldwide, the city offers a 10-year golden visa program, which can be obtained through property investment, entrepreneurship, or high-income employment, providing a strategic alternative to the now discontinued golden visa programs in Spain and Portugal. This shift reflects a broader trend where high-net-worth individuals are looking beyond traditional European options for lifestyle-driven immigration, attracted by Dubai's tax advantages and global connectivity. Key benefits for investors in Dubai include the absence of personal income, capital gains, and inheritance taxes, alongside fast-track visa processing and renewable long-term residency. The Emirates' robust infrastructure, anchored by the Dubai International Financial Center and Nasdaq Dubai, offers a mature legal system and access to major markets across the Middle East, Africa, and Asia. Additionally, the English-speaking business environment, U.S. dollar-pegged currency, and premium lifestyle amenities make Dubai an attractive proposition for American investors. As global capital flows adapt to new economic realities, Dubai's strategic location and tax-neutral framework present a compelling case for those seeking to relocate wealth and explore new opportunities.
Prologis PLD, a global leader in industrial real estate, has experienced a remarkable 25% gain over the past 6 weeks, driven by a robust rebound following earlier disruptions caused by trade tensions. The company's operations were initially impacted by the reciprocal tariffs announced by former President Donald Trump, which affected global logistics and supply chains. However, Prologis has demonstrated resilience, leveraging its extensive network and strategic assets to recover swiftly. The recent surge in Prologis stock price underscores the market's renewed confidence in the company's ability to navigate geopolitical challenges and capitalize on the growing demand for industrial real estate. Despite the impressive rally, analysts suggest that the stock may still be undervalued, presenting an attractive opportunity for long-term investors. The company's strategic positioning in key markets and its focus on sustainable growth initiatives are expected to drive continued performance, making it a potentially lucrative addition to investment portfolios focused on real estate and logistics sectors.
Global markets exhibited mixed performance as U.S. Treasury yields eased, following a turbulent week marked by concerns over increasing U.S. government debt. The yield on the 10-year Treasury fell to 4.52%, while the 2-year yield slipped to 3.99%, reflecting market expectations regarding potential Federal Reserve actions. Concurrently, oil prices declined amid speculation that OPEC Plus might increase output, with U.S. benchmark crude dropping to $60.99 per barrel and Brent crude to $64.23 per barrel. In equity markets, Germany's DAX and the FTSE 100 recorded slight gains, while the CAC 40 experienced a decline. In Asia, Japan's Nikkei 225 rose by 0.5%, following a report of a 3.5% core inflation rate in April, raising the possibility of a rate hike by the Bank of Japan. However, the potential impact of U.S. tariff hikes under President Trump could constrain the BOJ's policy adjustments. Meanwhile, U.S. markets saw mixed results, with technology stocks like Alphabet and Nvidia offsetting broader losses within the S&P 500. The passage of a multi-trillion-dollar spending bill by the U.S. House, which could significantly increase national debt, added to market uncertainties, particularly affecting solar companies due to proposed changes in tax credits.
The European Central Bank, ECB, is optimistic about a reduction in high inflation rates within the services sector by 2025, according to Chief Economist Philip Lane. This expectation is instrumental for the ECB's objective of reaching a 2% overall inflation target, which is crucial for maintaining economic stability and growth in the Eurozone. The optimism is largely based on relatively low wage contract settlements, which are anticipated to ease inflationary pressures in the services sector, a significant contributor to the region's inflation. Despite this positive outlook, Lane acknowledged several external risks that could disrupt this trend, including global economic shocks, exchange rate fluctuations, and volatile energy prices. These factors, influenced by changes in the global trading system, could complicate the ECB's efforts to maintain price stability. Nonetheless, the ECB remains hopeful about steering inflation towards the desired target, which could positively affect market sentiment and reassure investors and stakeholders about the future economic environment in the Eurozone. This confidence may also influence future monetary policy decisions.
NALCO, National Aluminium Company Limited, reported a significant increase in its Q4 EBITDA, up 148.7% year-on-year, driven by higher realizations in both alumina and aluminium prices. However, SCC Securities has downgraded its rating on NALCO to hold, citing a balanced risk-reward scenario at the current market price. The brokerage firm anticipates a decline in future earnings as alumina prices have surpassed their peak and are expected to remain subdued, trading within a range of $350 to $400 per ton due to increased supply from China and India. SCC Securities also notes limited potential for volume growth in the near term, although NALCO's use of captive coal could provide a slight cost advantage. This downgrade suggests a cautious outlook for investors, reflecting expectations of stable yet unremarkable performance in the upcoming quarters. The implications for NALCO could include pressure on its stock price and a need to explore new growth avenues or cost efficiencies to enhance shareholder value amidst a challenging pricing environment.